Good morning, everyone. It is Wednesday morning, the 20th of May, 2020, and what I wanted to do, and I will try to keep this as brief as possible. I understand that the lengths of these videos are, I guess, a factor to be taken into account. So what I want to do is I want to highlight one of my favorites in terms of NASDAQ tech stocks. And I'm going to start by doing a very quick overview of the Tech 100, the NASDAQ index. And this is, for those of you who are brand new to trading or not familiar with it, these are effectively generally exclusively technology stocks listed in the US on the NASDAQ exchange. And this includes the FANGs, which is made up of Facebook, Amazon, Netflix, Google, Apple. And Apple as well, and they are the 5 biggest constituents, and they tend to be able to influence, because of their market cap, they tend to be able to influence the index alone. But there are obviously a lot more other ones than that, and that's really what I want to talk about. So looking at this and just going, I'm looking at it on a monthly time frame, so this is a much longer term view and just a general approach to this, taking into account kind of where price is at the moment. So I think first of all, the first thing I need to mention is that over the last 2 or 3 years, I guess I could say, despite Donald Trump's attempts to subconsciously sabotage everything, this has done incredibly well. In fact, this is, in my opinion, the single best performing index in the markets at the moment, and it is likely to continue to do that, predominantly because for the first reason is because we're now more of a technology-based society as opposed to industrial. And so NASDAQ effectively represents today's current society in terms of where we see most of our value. And so it has the least impact with negative news, and it seems to be recovering the fastest. It's almost completely recovered from the big hit that we took effectively from February through to April. So and it's looking relatively bullish here. All right, so am I saying here that we won't, we couldn't have a big knock and head lower if we have a second wave and there's a further kind of economic impact? Of course, I'm not saying that that's the case. I'm saying that this one appears to be the most resilient out of all the global indices and all the US indices. And so because of that, one of the ways in which I can approach it is, if we're in a bull market, it's the one where I anticipate the largest amount of growth if I'm able to trade that. If I have the cash as an investor, I anticipate aggressive growth there. And at the same time, I feel that it's going to be the most resilient. The only thing that would effectively impact this would be where technology becomes redundant. So having said that, let's move on and go and have a look at the first band. So I've color coded them here. So the ones I'm going to focus on are obviously there's green, there's a couple of amber ones where there's some warning signs that there's kind of a bit of a concern there. So let's just start off with the kind of thing that I'm going to be staying away from. And so what I've done is I'm looking for as much history as possible. And this is Alphabet, this is Google. It's absolutely fine, no issues there. And there's a lot of really good performing ones, but I'm staying away from a few that have kind of spikes and erratic behavior. So I'm really focusing on ones with the kind of smoothest growth potential, and there's a lot. They're all pretty good. So what I want to do is let's start off with this one. Why is this one amber? Okay, so Dexcom is amber because it's, in many ways, it's gone almost parabolic. This is now well overextended and is very likely as close to being guaranteed to come back down in price. Where do I think it'll come back down to? I think it's very reasonable to expect it to come down to 30,000 from where it is now, at the very least. When is it likely to do that? Within the next 6 months, almost certainly. It's now already well overextended. If you look at any of its previous moves away, if you think of the moving averages as true value, this is the furthest it has been from true value in a while, and therefore it's likely to come back down. I say within the next 6 months because these are candles, and I'm assuming within the next 6 candles there's likely to be a bit of a turnaround, but certainly within the next 6 to 12 months. And 30,000 is a reasonable correction for it, if not 20,000. But 30,000 I think is a middle of the road, and therefore a very reasonable one. So in case you're wondering, I've got an RSI indicator at the bottom here. Using these indicators, the most incorrect way effectively of using it, and the most commonly used and most incorrect way of using it, is to assume that when price heads above 80, for example, or above 70, it's effectively completely overbought, and therefore that is either an opportunity to start selling, and if it heads below and it's completely oversold, then that we should look to start buying. Whereas a more appropriate way of doing this is that, first of all, once it's above 70, it actually is usually a good sign that it's quite bullish at that point. And so, in fact, the correct way of doing it is to understand that when it heads above 70, it's now really established as bullish. Of course, as it heads higher and higher and higher, the idea that we should consider taking profits and exiting starts to fit on the table. But with regards to actually looking to short the market, we would normally not look at that until we see a lot more evidence. So overbought is not enough of a reason to go short. Oversold is not enough of a reason to go long. Okay, so this is certainly going to have quite a harsh correction, and that's going to be a bit painful for anyone who's effectively exposed to that. Then if I look at Autodesk, so if you're not familiar with Autodesk, and I'm not familiar with all the companies here, but I am familiar with Autodesk. Autodesk is a software company, effectively. And they started out as this incredibly small fish that produced 3D Studio, which was a desktop application, kind of the poor man's animation software. And then as they got bigger, they started to acquire the big fish. And that was the biggest surprise. They started to acquire all the big software companies, and they produce they own almost all of the film and television visual effects, animation, editing software that exists out there. So pretty much most of the visual effects that you see in the Marvel Avengers movies or any big special effects blockbuster is almost always using Autodesk software. And so they're pretty steady. They own pretty much most of that market. And so we could see the reason for that growth. I am noting that they are heading lower. They're still technically in a bullish kind of area. But it just does imply you can see increased volatility happening here. And so they don't really have any big competitors. The issue might just simply be either market saturation or just, eventually if there's a market that the budget issues and therefore their clients start to lose cash. But they're switching to a subscription model in many cases, and therefore that will probably hit its biggest numbers as well. Then if we go on to Adobe systems, again, you should be familiar with Photoshop. So Photoshop and a few other beautiful gems sit within, if they're not with Autodesk, they're often with Adobe. And so that's just very steady. What I'm really looking at here is the stability of it. And they're pretty much ranging in bullish territory. So they're looking still positive. Can they have pullbacks? Absolutely. But it's a really nice, healthy, steady, stable behavior. Then if I go and have a look at Fiserv, and now I'm not familiar with Fiserv, but what I can say is this is absolutely beautiful in terms of the structure here. They took a bit of a knock recently, but they've recovered pretty quickly. Okay, so they are flattening out a little bit. They are starting to head into a little bit more towards bearish territory. But overall, the structure of this looks really good. Okay, so what will happen in the future if we do have a big knock, then we'll have to see how that goes. But the beauty of a lot of these companies is that they can be used from home. So if people are quarantined, they can continue to be productive using that, and therefore there will be less of an impact, practically speaking, on these. You'll notice that I've skipped over a few, like Comcast and eBay, because they're not necessarily that great. If I compare Comcast to Fiserv, it's just a better curve. And so therefore the curve implies the stability. If we look at Apple, Apple's pretty cool. One of the things I do notice is that the angle is starting to become steeper and steeper and steeper. I think we might find there's some resistance up here. What I think is likely to happen based off this and based off experience, and I'll assess it as it unfolds, is likely to see a bit of a consolidation. I think that this price growth, the angle of growth, is going to slow down. It'll either have a deeper correction and recover over the next few years, or it's going to slow down a bit. But this angle is becoming too aggressive to be sustainable, and that's basically the issue. It becomes unsustainable. Next, if I move on to Costco. Costco is one of my absolute favorites, and the reason why is it actually makes practical sense. Costco is cost effective. We don't have these, Costco doesn't exist necessarily all around the world, but it makes the most sense, and they become incredibly durable during recessions and during periods of, I guess, economic frugality, which means that they become more and more appealing to people on a budget. And so they're effectively going to thrive if we have a recession. And we're pretty much kind of there at the moment. Now, just notice that there's some struggling to get through that kind of past that 30,000 mark. Overall, I don't really anticipate any big knocks on this going forwards, unless their supply chain is disrupted. And so that could be a practical potential issue. But overall, it just looks really nice. The equity, the kind of growth curve, I beg your pardon, the angle here is a little bit steeper, but they're just so stable. This was their entire knock that they experienced compared to some of the other companies. It's nothing. So it's one of my all-time favorites, and it is Warren Buffett's as well, but you can see why as well. Intuit. Okay, so Intuit is on the list. All right, it's just what I would notice, and this is not a good sign, as it's become increasingly bearish. It's started to head down, even though price is kind of at flat levels here. But it's also, relatively speaking, has recovered, and it's sitting at its resistance level there, kind of close to 29,000. Then I've got Amazon, and Amazon, of course, is beautiful. It's broken through strong resistance here at 200,000. At some point, I think there's the potential for it to come back to test that level, but it's doing relatively well. Look at this, it's still very much in bullish territory. So it's already overextended. If you look at how overextended it was here, going back to September 2018 from the moving averages, there's a bit of a distance there before it came down. It's really nice and bullish here. It's just broken up. But that distance, the distance it is away from the moving averages now, from true value, is already effectively at its limit. So that means that somewhere in this area, in fact, I'll mark it. So I'm just saying that we've now entered that higher risk territory. Let's just say here. I mean, I would be blown away if it hit 300,000. I would expect it not to do that. I would say somewhere closer to that. Let's see. So that'll be an interesting experiment, but my expectation is to see it just do a bit of a pullback down towards somewhere around 210, 220, and even better is 200 to test that level for support. Overall, it's a beautiful one. I can't really see that going anywhere just yet. Going on to Amgen. Amgen is more about, despite the fact that it appears a little bit more volatile, it's kind of a steady volatile. And you can just see here, it's just ranging effectively sideways. So this is an indication of effectively stability. The fact that this is an oscillator, so it just means that it's kind of just going between upper and lower values, but it's going sideways. And so that's a relatively stable indication. Then having a look at Atlassian. This one is relatively new. It's young by comparison to the others. But it's just broken out through that resistance, kind of 15,000, clean break, starting to head away. It just has promise. That's all I'm really going to say at that point in time. And finishing off with Facebook over here. There's a couple more I want to show you. I'm almost done. Facebook is trying to break through its 21,500 resistance. Overall, it's still looking pretty good. They've kind of managed to win back a lot of their customer base, and there's some opportunities for good business as well, revenue and groups and activity there that isn't just social the way that it used to be. And they've stopped a lot of the really silly things and annoying things that they used to do, where they lost a large chunk of their client base over the last couple of years. Especially with things like clickbait and just ridiculous things where they were showing friends of friends of friends content in your stream that you had no interest in. Bizarre stuff like that. But now they seem to have come back to their kind of core thing, and the platform is relatively stable. So it's trying to get through that, and it's not through yet. But overall, it's produced higher lows recently, and is still leaning more to the upside. And even here, you can see we've got higher lows. So it's still angling up. It's effectively not overpriced at this point anyway, and so it's still got that potential to operate in this area as bullish. So I'm leaning towards this at some point successfully being able to move beyond that. And then the beauty of this is that if it does manage to move beyond that, it's not overpriced. It's not that far away from true value already here. So then going on to the last batch, there's not much more left. So is Microsoft. Microsoft is solid, man. Despite all the stupid conspiracy theories going on around Bill Gates, I just don't think he just gives a rat's ass that way. And anyway, so I do note that we are still a little bit lower. You can see that this curve is nice and steady and stable, but I would also note that it has gone a little bit low. So in other words, this high here is much higher than that on the chart, but it's much lower in terms of kind of where we are. This just, I guess, implies that we're starting to head into an area where we're likely to see either consolidation or a bit of a correction. But overall, the point is that historically it's relatively stable. They've also switched to a subscription basis, and you know, I mean, Excel for me, considering my background, Excel is still one of the most amazing and most underrated software packages in the world. I mean, or apps. It's absolutely incredible. So believe it or not, there are some things that Microsoft absolutely excels at, and other things that are just bad ideas, like the Zoom. Point is, it's a stable one. It's relatively nice. And then let's have a look at NVIDIA. So if you do gaming, you'll know that NVIDIA is now also a big player within the film industry as well, because of the graphics capabilities. Okay, so they're all looking good. They've obviously had a bigger correction in the past, and they're now also away from the moving averages. They've also broken past their highs. So in this area here, there's likely to be a bit of a pullback and a bit of a correction, potentially back down to 30,000 in this case. But they're still looking good. still looking nice and healthy. Aside from very much needed pullbacks to come back down, this is worthwhile keeping an eye on that as well. You can see the moving averages all the way down here. So what that does is that means that the area where price could potentially correct is somewhere around about, so let's call it down to about here, if that's going to be the case. Somewhere in that area where price will, somewhere in this area, my expectation is it'll turn, it'll come back and find a basis somewhere in this area as well. And so that's NVIDIA. And then last one on my list is Vertex. Okay, so Vertex, I just wanted you to kind of be aware of it, is mainly because it's just a consistent grow. It's also now overextended. 25,000 is a good price, or a good price for it to come back to. It's looking relatively stable, but I'd also, even anyway, 20,000, 25,000, but this is the last one on my list for now. And really it's the kind of just the general stability. And look at it, I mean, it's been a lot of these that have been performing incredibly well over the last 3 or 4 months are worthwhile. Look, the market's always going to kind of breathe out and breathe back in. So if it's had a boost now, at some point it'll calm down again, because potentially that could have been as a result of panic buying. And so when the panic buying kind of calms down, it'll come back down again. And then essentially if we do have a second wave, which is historically likely, we might have a bit more panic buying. But yeah, so very, very interesting. And so this is my complete list. I'm going to kind of wrap this up here, but these are my favorites. I think what I'm going to do as well is go through the Dow. So I'll have a look at my favorites from the Dow. But, you know, in terms of both trading opportunities as well as investment opportunities, I'm a big fan of the strongest of the strongest, and these ones have some great potential. And basically my selection criteria has been predominantly the historic stability, plus kind of staying away from ones that have these parabolic curves where they've kind of gone a little bit too steep. Apple being a good example of that, where I have that kind of concern. Do I expect that there will be, you know, drops in prices and then recoveries and then continues? Absolutely. If we do have a second wave, statistically and historically, it's likely to be much worse. Usually it can be 5 to 10 times worse in terms of the damage it does. And so we could have a steeper and deeper correction. But these are selected based on their resilience, and some of them have hardly even taken a hit. And so that means that, in theory, of course, they are less likely to take a severe hit. And just judging by the overall technology, how little it's... In fact, if anything, we almost more depend on technology now during quarantine. So possibly this is going to be something that we're going to see grow while everything else kind of starts to fall down around it. But certainly these are good performers. Okay, so I'll leave you with that. Please give me your comments and feedback. I'm always interested in that. Very interested in that. This is my kind of technical feedback and my thoughts on those.